Greetings, my name is Kevin Matthews and I am the tax professor. I want to welcome you back to class. Remember, class is still in session because the learning never stops. And today's topic is going to be about the streamlined filing compliance. And so this is a topic that it's kind of interesting because we've made several different videos that are talking about a lot of the filing requirements for people who are living overseas, people who come here to the United States. But a big question that sometimes comes to our firm is, hey, what happens if I haven't been doing that? And so usually people will reach out to us and say, hey, look, we need to schedule an appointment in order to talk about these issues. And I kind of wanted to shoot a video to just kind of talk about it in the long run. But here's the thing. Oftentimes what happens is that, when we run into people who've done this, it kind of falls into two parts. Either A, they just move overseas, and so then they say, okay, I know I need to be able to do this sort of stuff, and I need to file and be compliant and all that stuff, and so we go ahead and we hook them up with all of that, and that's usually pretty much the easy thing to do. Another very common thing that we tend to run into is, hi, I'm an U.S. expat who's been living overseas, and I've been here for about 10, 15 years, haven't filed tax return the whole time. What do I do? And the IRS has actually come back and said, okay, there's going to be what they call the streamlined filing compliance, where they're going to allow you to get right, but at the same time, they're going to have a certain amount of requirements that they're going to do on their side. And so you want to make sure that you're actually following a lot of this stuff. And if you follow the procedures as is and go to the IRS first and say, hi, I made a mistake, mea culpa, I want to get clean, they're going to be able to do a lot. You're going to be able to go through this streamlined filing process, and they're going to be able to get you right on that. If they catch you first, however, streamlined filing may not be an option, and we'll kind of talk a little bit about that other time. So, who does this video apply to? So, assume the situations that you are a U.S. tax resident that has just come here to the United States. So, you come here to the United States, and you have a green card. Okay, so if you get the green card outside the United States and then move into the United States, the day that you arrive in the United States with your green card is the first day that you are taxable in the United States, just like anybody else. That's a U.S. citizen or another tax resident. Okay, yeah, it's going to be taxable on your worldwide income, whether it's earned here in the United States, abroad, doesn't matter. Okay, you're going to be taxable on that. And we made a video that actually talks a little bit about some of the residency, and I'll go ahead and I'll put that up in the screen actually over here. The next one is that if you hit the substantial presence test. Now, if you come to the United States and you don't have a green card, maybe you come here on an H-1B visa, maybe you come here on L-1 visa, and you're here in the United States and you're here for a certain amount of time, you're going to trigger that substantial residence test. And again, it's going to be about 183 days. And the way that 183 days gets calculated is actually discussed in that video that we talked about, and I'll put that up on the top also for your good reference on that. Another situation you could have is that you're a U.S. tax resident who's living overseas. So, for example, and more often than not, where we see the commonality of this is you'll have a U.S. citizen who basically says, I'm going to go work over in another country. Very good example. I did the exact same thing. I used to live and work in Japan as an English teacher. So I left the United States, went to Japan, became an expat. And during my time as an expat over in Japan, I qualified for a lot of different treaty benefits in order to be able to allow me to reduce my income that was taxable here in the United States. I say treaty benefits, but also there were some U.S. code benefits too. We talk about those in other videos, and I'll go ahead and refer those. So the foreign income exclusion, and then we'll also have, then of course the foreign tax credits would be some other things you qualify for. But it has nothing to do with those rules. It's more often than not that people who move over to overseas and then stop filing, the most common reason that I hear was, well, I was talking to all my friends in country X, and they said they didn't have to file tax returns if they went outside the country. Well, most countries outside of the United States are what we would refer to as territorial tax systems, which basically means, hey, if you are living in the country, you're taxable. If you move outside of the country, you file a statement with your tax authority, don't have to pay taxes in your home country anymore. So a lot of times that's the process that ends up happening. And so sometimes Americans overhear this and they say, okay, well, our system must be the same way. And instead of talking to somebody who knows what they're talking about, they're going to have that. And oftentimes, most of the time, CPAs don't know these rules, or if they do know the rules, they know them at a very rudimentary level, because here at Beta Solutions, we do specialize in the international tax arena, so we deal with these issues on a daily basis. I've talked to a lot of CPAs that they'll have maybe out of 400 or 500 clients, they'll have somewhere in the neighborhood of about maybe about 4 or 5 that are actually dealing with international issues. And then, oftentimes they're coming to me and asking me, hey, Kevin, I got this weird question. How do I do this? So they go overseas and they don't file tax returns. But the biggest thing that's actually come up as a result of the FATCA law that got passed, they actually don't also report their bank accounts, which is a very important thing. So there are 2 systems that require you to file, that you're required to file for with reporting of foreign bank accounts. And again, we put that into a video that I'll go ahead and put up on top so that you can take a look at. And basically what ends up happening is that with the failure to file the foreign accounts, like I said, there's 2 agencies that are involved with this. One of them is FinCEN, which is the Financial Crime Enforcement Network. And then you also have the actual IRS filings. And, even though they're both Department of Treasury, they actually fall under 2 different governmental requirements. Now, over time, originally, FinCEN had its own thing, and then the IRS had its own thing, and then they began to realize, well, why don't we merge these 2 together? And they've actually been moving them closer and closer together. They're still 2 separate agencies. They still have 2 separate reporting requirements. They still have 2 separate, 2 separate procedures for doing the reporting. But they have merged a lot of those systems together because they've realized it's in everyone's interest to do so. And so you are required to file and report on your bank account balances when you live overseas. Now, under FinCEN's rules, if it's anything, if your bank accounts in total, and they add all your bank accounts together, if any of your bank accounts in total ever total more than 10,000, you're required to report. Now, on the IRS, if you're living overseas and you're single, it's not till you hit 200,000. So, with the IRS, there may be less of a concern. However, the FinCEN, the $10,000 requirement, doesn't take much to get there. All you have to do is live overseas and just say, hey, look, you may have a situation where you're living month to month, and you say you're living in downtown Tokyo, you're living in Hong Kong. $10,000 is not a hard number to hit, living in those cities. So it's something that we do see what's happening. Now, some of the penalties that can end up happening is, number one, if the IRS audits you and hits you for all of this, you'll have to file all of your tax returns, and they're going to hit you with interest penalties for all tax owed, and it can get ugly. Okay. Now, if you ever run into that situation, you better be hiring a CPA who knows what they're doing, because there are ways we can get you out of some of the stuff with the audits, particularly if you're only making between $100,000 and $150,000. Oftentimes there's a lot of stuff that we can do that can get you away from a lot of this. But one of the other things that can end up happening that's not really tax concern. So, for example, say you live over in another country, say Germany, and you want to come here to the United States, and you've gotten married while you were over in Germany, and you have two wonderful kids. Well, you're a U.S. citizen, so they're not going to stop you from coming into the United States. Your kids are entitled to U.S. citizenship, but I've seen it in the past, and I actually had a couple clients we were worried about with this. They tried to get visas for his wife and his kids, and they were both denied. And so as a result of which, what he had to do, they said, look, we noticed that you haven't filed tax returns ever. In this guy's case, it actually wasn't that he was a U.S. citizen and moved over. He was born a U.S. citizen, didn't know it because his mother had moved him over to Europe during the time. And then once it had ended up happening, he tried to come to the United States and applied for a visa. And of course, they're like, well, we don't need to give you a visa. You're a U.S. citizen. And, oh, by the way, you've never filed tax returns. And he's like, I didn't know I had to. So they ended up hiring us in order to be able to get their tax returns filed and get everything done. And it all worked out in the end. But, it was a 6-month process that, he was separated from his family. It's not a good thing. So you want to make sure that you get that taken care of. The other thing they can do is they can put a lien on your account if they figure this out at first, and then that could hamper credit opportunities. that could also hamper. So for example, if you have a house here in the United States and after you've been overseas for say 10, 15 years, you decide, I don't want the house anymore because it's becoming more of a pain in the butt, blah, 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 I don't want to deal with it any longer, and I want to sell it. Well, you sell it and all of a sudden the IRS says, well, you owe us a ton of money because you've never filed tax returns. They can prevent you from getting your money. So that's actually a lot of stuff that you don't want to have to deal with. The environment, like I said, has changed over the past few years. One of the biggest problems that we've had, and I remember when I was a kid growing up in the 1980s, I remember hearing about, rich people who had Swiss bank accounts. All these rich people have Swiss bank accounts, and what ends up happening is, you would go to a Swiss bank account, you open them up in the account, and you put money in there. And one of the reasons why they do it is the Swiss authorities would never report any of it. And so because the Swiss authorities would never report any of it, it tended to end up being a good deal for the taxpayer because, they're making money. And the Swiss banks back then were charging pretty good interest rates. But, they wouldn't tell the IRS about it. So, you're making tax-free money, so to speak. Actually, technically, it's not tax-free. It's illegally not taxed money that you're actually earning. And so what's happened in the past, since then is that, we've passed legislation that has actually kind of broken that whole system. Now a lot of Swiss banks actually do report to the United States. More importantly, a lot of banks in a lot of different countries are also reporting to the United States and says, hey, we've got U.S. citizens who have bank accounts here, and they're going to report balances, they're going to report interest, and all that sort of stuff. So the IRS is getting more and more data that they weren't getting as much as 30 years ago. And also, as tax systems become more sophisticated in other countries and data analytics becomes more sophisticated, you're having greater amounts of income and expenses that are being brought up that are being reported to the IRS that wouldn't have been reported in the past. You have to understand what really caused a lot of this. In the past, countries didn't really have a desire to work with the United States on that. And it's not that they wanted to do something to harm the United States. There's no vested interest. So, for example, if you're Germany, why would German authorities seek to work with American authorities in collection of tax revenue? Because one thing that we see in the international region is, well, if you scratch my back, I scratch yours. But if German citizens move to the United States, they're not taxable in the German system anyways, because they're a territorial system. So there's no method, there's no reason for them to want to help them out. So there's been a lot of reasons, for them not to be supportive in the past. Something that's ended up happening is that as treaties become more sophisticated, as more time has passed, we've negotiated better deals with countries overseas, and now they're doing a lot more of that reporting to us, or at least giving us paths in order to have the IRS go in and actually figure some of this stuff out. Another thing that really happened was the pass of the FATCA. FATCA legislation that passed in the early 2010s. Basically, what ended up happening is that it made it very difficult for them not to comply with this, and I've built a video that actually does all of that, and I'll put that up on the link here too. So you receive notification that basically says, hey, look, you haven't filed tax returns. Now, that notification could come in one of several different forms. One, it could come directly from the IRS saying, hey, we haven't seen any tax returns. You need to file tax returns, and if you don't, we're going to come after you. The other thing they could do is they could say, we haven't filed tax returns on you. We've received information about some of your income. We've gone ahead and filed those tax returns for you on your behalf. And oh, hey, by the way, you owe us X number of thousands of dollars. By the way, penalties, interest, and failure to file penalties and all that sort of stuff. Instead of it being $2,000, now it's like, $6,000, $7,000. Those can be very ugly. Okay. The next thing is that, maybe you're trying to get visas for your family members, and you try to do this, it doesn't work out, and next thing you know, you're struggling to get those visas, and so you basically realize that you need to get that taken care of. Now, there is a streamlined procedure for filing the amended tax returns and delinquent returns. Okay, so what ends up happening is if the IRS files returns on your behalf, you have to file an amended return to fix it. So there's a process that you have to go through, and it's not an easy process because first things first, you got to figure out what the IRS filed on your behalf. They may have told you, or they may have just said, no, we filed the tax return on your behalf based on the information that we have. And so there's processes that we can use in order to get that data and get that set up so that we can do that. Now, if it's just simply a delinquent return, we just go ahead and build the return and we send it off and we file it. The terms for resolving any tax liability, according to the Streamlined Procedures, is that the individual may be able to use these procedures in order to resolve any outstanding, tax liabilities, interest, and penalties, or at least mitigate them. Sometimes you're going to find out you owe money and there's nothing you can do about it. And so what will end up happening is you got to get that taken care of. Under certain conditions, the procedures remain available if the previously filed amended tax returns is an attempt to address tax information and reporting obligations. So if you're filing these tax returns, not necessarily to pay tax, but to do the reporting obligations, this is also something that can be used in order to be able to help that out. That said, however, any penalty assessments previously made with respect to those filings do have to be paid. And, so usually what will end up happening is you file the tax returns, you go to the IRS, say, mea culpa, here's everything that I've got, I'm sorry, I owe you $10,000, and hey, by the way, here's interest and penalties to go with that. And so you need to get that kind of taken care of. So what exactly will you have to do? Number one, you're going to have to file, if it's tax returns that you're delinquent on, you're going to have to file for the past 3 years. Okay, so we gather your tax returns, get the 3 years worth of compliance together, and make sure that it has all the forms that are necessary. And the thing that the Streamlined Procedures mentions as examples is make sure that you have 3520s, 5471s, and 8938s. 3520s, Form 3520s is if you have a foreign trust or if you have any gift issues that are foreign that we have to kind of deal with. 5471s if you are an owner in a corporation in a foreign country and it qualifies as a closely held corporation, you've got to make sure you file those. And the 8938s, which is actually referring to the reporting of financial assets. Again, if you're overseas and say you're married and it's just you and your wife and your total assets is less than $400,000 if you're married filing joint, there's not a requirement to necessarily file, but there could be some other reporting requirements, like again with FinCEN or with some other stuff that may need to be done. Because even though you may not have an 8938 reporting requirement, some of the assets that normally get reported on 8938s or as part of the 8938 structure may still be triggered. So for example, you receive a gift for $100,000, you still have to have the 3520 filed, even though you may not file the 8938. So there could definitely be some issues there. If your delinquency is related to the FBAR filings or the FinCEN 114 filings, you have to file those for the past 6 years in order to get compliance. And then what ends up happening is that if it's an offshore penalty, it's going to be generally equal to 5% of the greatest aggregate value of your financial assets during the years covered in the tax return period. So if we get done and say you had a bank balance of $10,000, the absolute minimum at 5%, that easily runs into a $500 fine. Okay, that's just if it's $10,000. Say for example it was $50,000. Now your $500 fine is going to be $2,500. You see how this can add up and expand very quickly. Now, and again, this is purely anecdotal. I don't know if how this works out. We have been successful in the past where we actually did this for somebody and requested that they not charge them the 5%, and we did get out of it. Now I will tell you, I don't know how often that happens, and I know that the FinCEN was very generous in not charging it. I think they do a facts and circumstances, and then they make a determination as to whether this was done intentionally. They also make a determination whether it was egregious. If somebody had $4 million overseas, probably a different circumstance. I think one of the other things that we had kind of told them, we put some mitigating circumstances that go into it. I'm not going to get into the specific details of it. But I think some of that, they kind of came back and said, okay, we're going to waive it. And they're very generous in doing that. And we're not, I'm not saying that that'll work for everybody or that it should work for everybody. But it is something you might want to investigate. The full amount of the tax and interest due in connection with those filings must be remitted with the delinquent returns. And so you want to make sure that gets taken care of. So you go through this entire process, you calculate your tax, you find out that you're going to owe $12,000. You're going to be like, what? I just went through all this. What am I getting out of this? Well, number one, you're getting compliance. And look, you're talking to a person who has sleep issues. I have a lot of times where I have a hard time sleeping. Anytime I'm into a very high stressed environment, a high stress situation, similar to COVID-19, I tend not to sleep very well. Sleep is a very important thing. I know it sounds like a very minor thing, but sleep is essential to health. Compliance not only gets you that, but it also gets you out of having any of these problems. I mean, not being compliant can cause a whole lot of issues for you, and it's just not a good situation to be in. I would say that, just getting the compliance should be more than enough in order to be able to get you out of it. Yeah, you got to pay some penalties. Yeah, you got to pay some interest. There's nothing you can do about that, but it is what it is, and that's kind of what we've got to deal with. So if you're eligible to use the streamlined procedures, you will not be subject to accuracy-related penalties, which actually those can be substantial. So you want to make sure that you try to get these streamlined. And again, it's like it works a lot in various types of law. If you're the first to go to them and say, "Hey, mea culpa, I made a mistake, help me here," they'll be willing to get you on the clean side of things. If they come to you after finding out that you've made a mistake, your goose is cooked, and they're gonna put a nice little roasting and nice salt and pepper in order to make sure it tastes good going down. You definitely want to make sure that everything gets taken care of and gets taken care of properly. So here at Beta Solutions, we can actually help with all this. We do have the necessary experience with this. I do have the knowledge in order to do this. This is a specialty that we do, is the international world, and we definitely want to help. And so if you want to reach out to us in order to be able to discuss your case like this, go ahead and reach out to us at www.betasolutionscpa.com. Again, that's www.betasolutionscpa.com, and we'd be happy to help you out with this. So in conclusion, what I'd like to do is say thank you very much for watching the video. If you liked the video, please go ahead and hit the like button, and we'd be very happy to have that, because obviously likes are what get this get the stuff going. And then if you if you really like the video series, I'd actually ask that you go ahead and hit subscribe to our series, because we're going to be putting out more of these videos. This is season 3. We've already put out quite a bit of videos. I'm telling you what, guys, season 3, it's exciting. I'm looking forward to getting to episode 100. I mean, and I know that we're going to get there. It's just going to take some time, but it's definitely something that I'm really looking forward to, and by your continued support of hitting the like button and also hitting the subscribe button, we'll be able to achieve that. So again, thank you very much for watching.